My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. Today, zooming in from Knoxville, Tennessee, we have a very interesting guest. Harper Jones is a real estate entrepreneur, real estate investor, and he's also an infinite banking expert. So we're going to talk about how Harper kind of combines both of those things, infinite banking and real estate investing. So Harper, welcome to the show. Great to have you.
Thanks for having me, Dave. I'm real excited to talk infinite banking and how it complements real estate.
Yeah, well, that sounds good. So first things first, we're starting Q2 of 2025. You were telling me off camera that you kind of split your time 50-50 between real estate and infinite banking. So what does real estate look like for you? Let's start with that. What do you invest in? What kind of projects? That sort of thing.
Sure. So I started out 9 to 10 years ago in residential, but now we've migrated more into commercial. So the real estate holdings we have are 7 or 8 storage facilities I have with 2 partners. We just use in-house capital, normally have a partner or 2, and then a minority owner in some mobile home parks, and then also have some industrial buildings. And that consists of the commercial real estate that we have and that we hold for the long term. And then, of course, on occasion, instead of wholesaling, say, a residential property, I'll come across a commercial property and I'll flip that off and do a commercial wholesale, right? Get some more capital and then, go buy another long-term hold, whether that's storage or a mobile home park or industrial.
Okay. So the properties that you hold, are they in and around Tennessee primarily or all over the place?
Primarily, they're within an hour to 2 hours of Knoxville, Tennessee, so East Tennessee.
Yeah.
And then depending on the size of a property, we would go further away. So one of the mobile home parks is around Birmingham, right? And then everything else that I'm invested in is within about hour to 2 hours in Knoxville.
All right. So are you guys actively managing these properties as well? Are you involved in the day-to-day or not so much?
Sure. So the industrial doesn't take as much on the management side once it's up and running,
Yeah.
but I kind of head that up. And I have one partner there and he's helping out, but that's pretty easy once everyone's all set up. And the storage facilities, we have 7 or 8 employees, some part-time, some full-time, have a couple virtual employees to help with the day-to-day and admin, which is really cool. My brother heads up that management and operations. He does a great job. And then the mobile home parks, I'm minority owner, so I'm not the main operator. I just invested. And so I'm a little bit more hands-off there.
Cool. All right. So you combine real estate investing with infinite banking, and I'm sure a lot of our listeners and viewers have heard of infinite banking, but maybe they're like me and they don't quite remember exactly what it is and how it works. So tell us a little bit about what infinite banking is. What is your definition, first of all?
Sure, Dave. So infinite banking, I think, can get a little confusing from time to time because people will use slang terms, put their own little branding on it, or turn around and word it different ways. But essentially, infinite banking is about recapturing the banking process that's already out there. So for example, think of a traditional bank like a Bank of America or Wells Fargo or a local community bank that you may use. While those are very important, we're always going to use them. We are just the customer when we deposit our money at that bank. We are not the owner. And the one who's getting the majority of the benefits is the owner because they put up the capital. Now they're taking on the deposits, loan it out, and they profit, right? And they give a little bit back to you. They keep the difference. Now, of course, they're a business. They need to profit. But we say, hey, how can we recapture some of that profit or lost interest? And that means we need to start practicing infinite banking ourselves or the banking function, right? So then we can get into how we do that.
Yeah.
But essentially, infinite banking is recapturing that process or some of that process. Does that make sense, Dave?
Yeah. So let's just dumb it right down, Harper, and let's say, like, who would be a typical infinite banker? Like, not the super high income, high net worth type people, but like an average Joe infinite banker. How can they apply this themselves?
Sure. So if you're going to start practicing infinite banking, you obviously need to keep more of the money or save more money than you spend, right? Because you got to have some capital, right?
Yeah.
Before you
So,
deploy that
so
capital.
give or take, how much capital do you need realistically to get started with infinite banking? How much should
Sure.
you have saved up?
I'm going to give you a little bit of a it depends answer because it does depend on the individual.
Yeah.
But I would say the average amount of money someone's flowing through their policy, their system a year is about $50,000. But I work with people who funnel less than that and people that funnel much more than that, right?
So
So
what does that even mean? So they need to save $50,000 a year for this to make sense. They need to start with 50,000 and get rolling with that. What does that actually mean?
sure, let me back up and describe how we would flow the money in there. It's going to make a little bit more sense.
Sure.
So when we're thinking about money, we think about two things mainly, which would be savings and investing, right? So, for example, you're going to use a traditional bank to save your money, right? You're going to use real estate, for example, to invest it. And there's a distinct difference.
Hmm.
Savings is more liquid, more guaranteed, easy to access. You can rely on it, right? Now, with investing, there will be a little bit of risk with it. Could be more risk depending on what you're investing in. But the point is, investing is going to give you a higher rate of return, build more wealth, but it's not going to be as liquid or as reliable, right? Maybe a
Right.
long call it can be. So when you separate the two, you say, hey, how can I put my savings to work? What is the ideal savings vehicle to put my cash or warehouse my cash before I deploy it into investing, right? And so if you're going to do that, you would ask yourself, what are the ideal savings characteristics I would look for? And some people might use a money market or a savings account or something of that nature to save their money. But we say, okay, what are those attributes we would look for? And they would be, I would like a competitive rate of return, right? I would like guarantees. I would like it to be liquid. I would like it to be creditor protected, as in if something were to happen lawsuit wise, it's harder for creditors to get to. I
Hmm.
would like to be able to leverage against it because leverage in life is very important. And at the end of the day, if we can keep it tax free and compounding uninterrupted would be awesome. Now, like I said, a savings account, a money market, those accounts, while they might give you some, or those vehicles give you some of those attributes, they won't give you all of them.
Yeah.
Well, one asset or vehicle that will check all those boxes is a life insurance contract with a mutual insurance company. Now, when that's set up, that would be your platform or your product you would use or vehicle rather than a savings or checking account, or sorry, more savings or money market account where you have money sitting kind of warehoused within that life insurance contract. And it actually checks all those boxes. Now, when we need to access our capital or cash to go invest, we simply borrow against that life insurance contract and leverage our dollar in two places. So I'm going to pause. I know it's a little bit long winded, but we're talking
No,
about
I,
shifting.
I think you explained that very, very well. So most people, when they're saving, if they got the 50 grand that they've saved, it's in a bank account. And the good thing is it's liquid, they can get access to it, all that kind of good stuff, but it's hard to leverage and it's easy for other people to get access to it if they sue you, et cetera, et cetera. And it's not growing tax free. Versus if you buy this kind of insurance product, it shelters it. It is getting a higher return on investment there, and then you leverage it because you borrow against that. In a snapshot, am I getting that?
Yeah, yeah, for sure.
Yeah.
And
Okay.
when you flow the money into a life insurance contract, what you're essentially doing, if we place it with a mutual company, which we do, is we're becoming part owner in that massive insurance company. And then that makes us not just the customer with the insurance company, but also an owner, right, on a pro rata basis. So, in essence, an insurance company operates virtually identical to how any bank would operate. They have premiums come in, like deposits. They need to put that money to work to pay out the death benefits, expenses, commissions, whatever else, and still profit on top. So they loan the money out, sometimes to banks as well, and the banks mark it up with an interest rate. And at the end of the year, they still have a profit, right? Well, that profit that they would have, they actually issue on a pro rata basis to you and me if we have policies with them. So not
Mhm.
only do we get the benefits of a customer like at a bank, we're also getting the ownership benefits. So it does take a couple of years to get it going because you're essentially investing in a fresh business, right? Does that make sense?
Mhm. Okay, good. All right, so that's where we're putting our savings instead of in the bank. Are you able to add to that balance, or do you have to buy a whole new contract with a lump sum?
Yeah, sure. So the way these policies are designed is you need to shift the money over a couple of years to get it in there. So, for example, let's say someone had a couple 100,000 of savings, and then let's say they make 250,000 a year, just as an example.
Yeah.
I would say, hey, maybe we'll start up a policy where we're starting to shift over 50,000 a year for a handful of years, and then reduce what we put in there after a handful of years, kind of front loading the policy, so to speak, because the way that we have certain, I guess, ceilings or thresholds we have to stay within or bumpers,
Hmm.
we can only get so much in relation to how much we're originally putting in. So you can't just do one big lump sum. You got to kind of spread it out over a few years.
Okay. All right. So we've got our whatever that is in there, 100,000, $200,000 over a number of years. And it's generating some returns, but how do we really leverage this, and how do we do the other cool things that you do with infinite banking from
Yeah,
there?
sure. And one thing I want to chime in is I do have 5 to 8 minute videos that go over policy design and then a whole presentation on this. So if it does get confusing for any listeners, at the end, I'll direct you where to go to watch
Perfect.
that, the visuals.
Yeah.
And of course having to talk one on one. But how do we leverage it? So getting the money into the policy is the platform of the warehouse, right? Which is very important and is going to give you a lot of those benefits of that ideal savings vehicle, like I did. So you got to compare it to what you're doing with your savings now, which is not much usually, to hey, look at all these benefits you're going to get placing it over here. Now, as the capital's in there, like you said, how do we use it? How do we leverage it? There are two ways you can access your cash within that policy. You can either withdraw the cash, which would mean stopping the compounding, right? Which we don't want to do. Or we could borrow against it and get a line of credit against the cash or equity within that life insurance contract.
Now,
The,
are you who are you borrowing from using that as the
correct.
collateral?
Yeah, great question. So when the cash is in the policy, you can use a third party like a bank to borrow against it, but the preferred method is to borrow from the same insurance company you have the policy with because you have contractual rights or
Okay.
contractual guarantees to borrow. Now, remember, you are part owner of that insurance company, and there is not third party shareholders in this scenario. So they're not going to mark up that interest rate or mark it up nearly as much. So April 2025, we're talking, go borrow from a bank, might be 7.5 or 8% to get a line of credit. With these insurance companies, you could borrow mid fives, 5% right now all day long. Why is that? It's because there's no middleman needing to profit in between. Does that make sense? So we get a
Yeah.
more preferred access to our capital.
What kind of returns are we getting on the insurance policy itself?
Now, that can depend on how much you're funding, your age, your health, but what I usually see is anywhere from 4 to 5%
Hmm.
over the life of the policy in a tax deferred manner. Handled properly would be tax free. So it actually gets pretty strong over the long haul, especially when you consider the tax benefits and the death
Hmm.
benefit in there and being able
Yeah.
to borrow against it at a very preferred way.
Okay, so I got my $200,000 in the insurance policy, and I'm able to borrow against that from the same insurance company at, let's say, right now, give or take 5%.
Mhm.
So now what?
Sure. And I want to be clear, your cash when we're borrowing never leaves that policy. So it continues to compound uninterrupted, right?
Yeah,
24.
yeah, it's the collateral. You're
Correct. So
getting a line of credit based on that.
that's correct, Dave. So
Yeah.
when we get the line of credit called a policy loan in the insurance world, now let's say those funds hit our checking account. Okay. And let's just say we took $100,000 policy loan, right?
Mhm.
That $100,000, we would say, hey, I got a real estate deal. I'm going to go use the $100,000. And I'll give you an example, actually.
Yeah, please.
So, me and my brother bought a storage facility back in December of 2021. And the seller and I agreed on 800,000, and he ended up seller financing the deal. So, he was the bank. We put down $100,000. Okay. So, me and my brother both put down 50 each. And where did we get the money? We each borrowed from our policies $50,000 each, put it in the deal, right? 1 year later, we got it reappraised, and it was a mom and pop, and it wasn't ran too well, but it was a good asset overall. We reinvested some in it, got the rents up, got it stable. It appraised for 1.6 million a year later. Awesome, right? Well, what do? We did a cash out refinance, right? Replaced or really put a second loan behind the first. But anyways, we cashed out, refinanced $250,000, kept the asset, still cash flowing today. It's awesome. So we got our 100,000 back and an additional 150, right? For the 250.
Yeah.
Well, someone would ask, how much money did we have in the deal? And the answer is we only had the interest carry on the policy loans, right?
On the line of credit. Yeah, basically.
Yes, correct.
Yeah.
So we took the 100, repaid our policy loans plus interest, so a couple thousand each, and the rest we had tax free, right? And guess what? We get to recycle or revelocitize that dollar again and do it again. So you see how we're becoming our own banker or banking on ourselves or practice infinite banking. And that's where the term comes from.
Infinite banking comes from. Good. Very good explanation, Harper. That's great. I appreciate that. I was a little bit rusty on how it all worked. If people are watching this and they want to find out more and connect with you, where should they go?
Very simple. If you go to lifewithleverage.com, you can find me there, book a call, and then you could go to the About Us page or resources and see all the YouTube videos I've made, full presentation, 5-8 minute short videos on topics. But I'm more than happy to talk to someone if they want to learn, want to get a policy, or want me just to talk to them about a current policy they have and how they could use it better. Be more than happy.
Awesome. Harper, thanks very much for being on the show. That was very enlightening.
Definitely. Thanks for having me, Dave.
All right, everybody. Take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.